Today's video, we are going to be talking about the persistently high inflation and how the failed leadership of the Federal Reserve is now causing all this pain and misery to the economy, and that they should have done things much differently than what is taking place today. Now, this is something that you're going to hear from a lot of the economists out there, a lot of the mainstream media narrative, pushing this idea that Jerome Powell needs to be removed and that there's a new idea or strategy that should be deployed within the economy so that it can alleviate the pain that everybody is experiencing. And now what I find very interesting about a lot of this mainstream media narrative that you hear out there about what it is that the Federal Reserve should or could or, whatever. I mean, they got all these, thoughts and ideas and theories behind it. Very, very, very rarely do you ever hear any of these economists ever bring up the neutral interest rate, which is something that I have just been so adamant about focusing in on to understand what it is that needs to take place in order for the Federal Reserve to achieve their monetary policy strategy. Now, very difficult to understand because most people are just focused in on inflation and bringing inflation down. Now, that is not the goal of the Federal Reserve. I don't care what you hear or what they say out there as far as their 2% target and trying to bring inflation down to that 2% target. This is not how the Federal Reserve is trying to conduct monetary policy strategy. The Federal Reserve wants to keep an elevated inflation and inflation expectations going into the future. Now, they want the long-term inflation expectations locked in at that 2%. But right now, or in the past, or going into the future, the inflationary scenario may or may not be at that 2%, according to the Federal Reserve's own strategy. This is making up for past deviations. Now, if they run consistently below 2%, they will allow inflation to run above 2%. If it runs above 2%, they will allow it to go below 2%. Now, something very interesting is that after the Great Financial Crisis, this is back in, 2008, during the Great Financial Crisis, the Federal Reserve fired up quantitative easing. Now, this is something that a lot of people are talking about because the Fed has announced that they are ending the quantitative tightening. Most people have took that into an expectation that they will soon be firing up quantitative easing. Now, that's when they, print up money and buy bonds. But that's not what's taken place. And for people to truly understand what it is that the Federal Reserve is doing when they go into quantitative easing is critical to understanding how the Federal Reserve conducts their strategy. See, this is the thing about quantitative easing. They conduct quantitative easing at the lower bound of zero interest rate policies. This is when the quantitative easing fires up. Now, to understand that they are not going to fire up quantitative easing until they get the interest rates to zero is the key to understanding how it is that they are conducting themselves. Because most people have it in their head, it's only a matter of time. It's the race to zero, getting back to zero interest rate policy and quantitative easing. That's the only thing that they're focused in on. But that's not what the Federal Reserve is up to. See, it was already stated a while ago, like 7-8 years ago, that the Federal Reserve was going to try and have an elevated inflation expectation to make up for the fact that they had no more ammunition left. This is important to understand. When they had no more ammunition left, they had to switch the way that they conduct monetary policy. This is why they fired up quantitative easing and started using forward guidance. Now, if they are not operating at the lower bound of zero, then they're not going to be doing quantitative easing. And the idea of using forward guidance is the main tool now. Right? Interest rate adjustments are not nearly as important as they once were. Because everybody is focused in on interest rate adjustments, they cannot see how it is that the words that they are using is impacting the markets. They can't see it. They keep saying it. When is the Fed going to cut? What happens when the Fed cuts? When the Fed cuts? When the Fed cuts? And I'm thinking to myself, do you not understand that the information that is being deployed on the idea of what it is that the interest rate setting policy is going to do is the monetary policy itself? not the actual conducting of the interest rate adjustment, the communication about it. And now I've tried to share this so many times on this channel, over and over again. I try to share how it is that the current economy and the separation between those who have and those who have not is now created essentially two different economies that are taking place. Right? Here you have this extremely resilient consumer. How in the world can you have an extremely resilient consumer here in the United States when you have massive layoffs and paycheck to paycheck jobs that are becoming more prevalent within the economy, not like career jobs that are allowing you to have a good job that'll provide you with enough to have the house and the cars and family and retirement and all the stuff that goes with it? That's not taking place. Right? These average everyday jobs are becoming less and less, having less and less ability to provide for the American people, the American worker out there. These paycheck to paycheck jobs are essentially pinning the people on the bottom side of the wedge. Meanwhile, on the other side, the people who are sitting there on the upper side of the wedge, earning interest on their investments, watching their assets grow, having the ability to continue to consume on a pace that has never slowed down. This is where the focus is. That's why so many people are like, well, what is it they're going to do for the average everyday dude out there? Nothing. They're going to do nothing. There's nothing for you. There's nothing for you to do for them. Right? See, there was a time when they could get you working, like if they lowered interest rates and got people to go out there and borrow money, start buying houses and cars and going on vacation, the number one thing that would take place is businesses would borrow money and hire people. By them hiring people, more people working, more people consuming, and more people consuming meant that in imbalances to the supply demand and inflation would be found. It doesn't work like that anymore. It just simply doesn't work. People think, okay, well, when the Fed lowers interest rates, it's all of a sudden going to create all this inflation. It doesn't. I don't know where people get that idea from. Obviously, they weren't there during the great financial crisis of zero interest rate policies for like 10 years, and it produced an inflationary scenario that failed for the Federal Reserve because it wasn't there. In fact, if you go and just look at monetary policy strategies for a low neutral interest rate world, which is a speech that was given in November of 2018, I mean, he straight up says it in there. Pretty clearly too, right? He says, let me just read a little bit of this speech so you can get a good understanding. It says, as a starting point, it is useful to travel back in time in the 1980s and the 1990s when inflation targeting was introduced. The problem at the time was high and variable inflation that contributed to macroeconomic instability and unmoored inflation expectations, which in turn fueled high and variable inflation. They had problems. Everybody was looking at it going, man, inflation's a problem, inflation's a problem. To break this vicious cycle, numerous central banks instituted inflation targeting and variants thereof, with a focus on bringing inflation down to a low level and fostering the establishment of stable, well-anchored inflation expectations. This is how everybody looks at the Federal Reserve, trying to get inflation down, trying to maintain low inflation, right? 2% inflation target. This strategy worked extraordinarily well in the decade preceding the global financial crisis. That's the way they conducted themselves up until the great financial crisis. As central banks were able to achieve remarkably low and stable inflation, leading to a positive feedback loop between low inflation and well-anchored inflation expectations. So people would hear that and they go like, yeah, duh, dude, no problem. We all understand that's the case. Here's where it changed. Today, we face an altogether different set of problems stemming from a very low neutral interest rate. That is the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is a risk of inflation that is persistently too high, a risk of inflation that is persistently too low rather than too high. See, they had a problem. The too low of inflation was interfering with their monetary policy. They needed high inflation. They needed elevated inflation to raise the neutral interest rate. The neutral interest rate is the interest rate that is neither accommodating nor restricting the economy, and it was too close to zero. They were failing. This is super important to understand. The failed leadership was taking place back then. They were failing the people. They were failing monetary policy. Goes on to say this. Today's low neutral interest rate rates reflect the culmination of trends extending back 25 years. A quarter century ago, a typical estimate of the neutral rate in the United States was 2 to 2.5%, consistent with historical averages over the preceding half century. Since then, however, there has been a clear downward trend in the neutral interest rates in the United States and other advanced economies, with current estimates ranging from 0 to 1.5%. That's them admitting they were done. That's it. They had nothing left. It was over. Interest rate setting policy was no longer a concept for them. Why does a low neutral interest rate mean for a monetary policy anchoring inflation expectations? When recessions hit, central banks may not be able to reduce interest rates well below their neutral level to stimulate the economy as warranted by the effective lower bound on nominal rates. Right there. That was them admitting it. No power. No ability to stimulate the economy when a recession hits because no more downward adjustment of interest rates could take place. Super important to understand, right? All these people are like, oh, interest rates, Federal Reserve cuts. They had an entire monetary policy that was failing them on the interest rate setting policy. The interest rate setting policy was failing them, all right? Goes on. This shortfall of monetary accommodations would result in less desirable economic outcomes during the recession and recovery. In particular, inflation would typically undershoot its desired target during these episodes. The persistence of below target inflation rates in many advanced economies over the past decade is a testament to this dynamic. You see the problem that they had? See, everybody was just like, oh man, the Federal Reserve, they don't know what to do. They're going to have a problem with this inflation. The inflation is running too persistently high. They've failed leadership. They need to get rid of Jerome Powell. They don't know what they're doing. And everybody who is falling into that trap is literally missing it. They are literally missing. In fact, by falling into that trap of believing that the Federal Reserve has failed because of the inflation that won't come down, it's persistently high, is literally giving the Federal Reserve the power that they needed. I mean, they said it right here. We need inflation that is persistent. The problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. This is the goal. Get inflation persistently too high. That's the goal. To get the neutral interest rate off the lower bound of zero and to regain the ammunition that the Federal Reserve has lost over the previous 10, almost 15 years, even going on from that, almost 20 years now. Right? This is the monetary policy. Everybody else is like, oh man, look at this, look at the repo, look at all these things going on, all this craziness. And I'm thinking all that is literally lending power to the Federal Reserve. Here, Fed, all the power you need, everything you need to do, conduct your monetary policy. Okay. All right, infamous NYC, thank you so much for the $5. Would you ever consider offering more content by going into, say, companies like Home Depot, etc., to expand more info on economics? I mean, I guess I would. I don't have a tendency to go into businesses or something like that, but I would interview people, at a time. The thing with the interviews, and I'm not trying to make up excuses or anything like that, but the thing with the interviews is most of the time, people who do interviews do them during the week, during business hours, and I have a day job, which means that I have to schedule it very carefully. Right? And for an example, when we did the interview with Peter Schiff, it got rescheduled twice in the day, and I had a heck of a time trying to schedule in lunches and stuff like that for my day job in order to get that interview done, because I'm doing it during my lunch break, when I'm doing like at work. So trying to get that scheduled in and do all that stuff is kind of a logistical nightmare if you don't have like the opportunity to be flexible within it. So that's just my excuse on these things, and I would really love to do more interviews because they're a lot of fun, and I think I do a pretty good job of conducting these interviews, at least the ones that I had done, a dozen or so that I had done in the past. And they're awesome. They're really good. They're really good, fun conversations to have. But that's just the thing. Most of the time they're done during the week and when I'm at work. All right, the Fed could actually cool the economy with rate hikes. I don't think they can. If that was the case, then they would have cooled the economy already with the rate hikes, but that didn't happen, right? The economy kept it going. Now, the average everyday dude felt the pain from it, and they can slow that guy down, right? Which is layoffs and, standard of living reductions and all this other stuff because of the elevated inflation. But as far as cooling the economy down with elevated interest rates, that's not the case. That's like saying that they can stimulate the economy by lowering interest rates. If that was the case, then they would have found that happening after the great financial crisis when they operated at the lower bound of zero for almost 10 years. It failed them. That failed them to produce the inflationary scenario that they were looking for. I mean, this speech right here, Monetary Policy Strategies, is about that very thing. Right? I mean, it's about how they failed to produce an inflationary scenario after the great financial crisis. All that money printing didn't do it. So to take on the idea that when the Fed lowers interest rates, that stimulates the economy and causes inflation, and when they raise interest rates, that slows the economy down and reduces inflation, is completely naive. That's the way it used to happen. That's the way they used to conduct themselves, and it was very appropriate to think that way. But after the great financial crisis, that is ridiculous. It doesn't work like that anymore. And anybody who seems to think it does is really delusional. They are not seeing it properly. There is like the Phillips curve broke down. It doesn't work anymore. The idea that there could be unemployment reduced to historically low levels and not produce an inflationary scenario like after the great financial crisis, the end of the Obama administration, all the way through the first Trump administration, it didn't create the inflationary scenario. This is historically low unemployment, low interest rate environment, didn't produce the inflationary scenario that they were looking for. We have to look at it differently. This is not the same game that we were taught back in high school or college or economics, college courses or whatever. All that stuff can be thrown out the window now. It's good to understand it. It's good to understand what it is because it's important to understand what it is and how it used to work so that it makes sense to understand how it is that they deploy words to the people who assume that's the way that it works, right? This old form, they assume that's the way that it works, and then they deploy words that push that expectation and then actually deliver results into the economy. All right? I know I'm the only one who talks this way, right? I understand that. All the information that I got that leads me to understand this theory came directly from the Federal Reserve itself, like by reading speeches like this. Let's go take a look at this other super chat. We got one from Buffalo Blanco. Thank you so much for the $4.99. Hey, UE, since the Fed is aiming to get near neutral, is any more credit faults like how it happened to Tricolor? I see something similar to Carvana. Credit faults like... I don't know what's going to happen with these corporations and how they position themselves. I don't know what it is that the Federal Reserve would do to create like issues within those banking systems outside of their position that they hold. Like hold on. You know what the problem with like the Silicon Valley Bank? Like these banks were sitting on assets that once the interest rates went up, the asset price fell, right? So when the Federal Reserve raised interest rates, the asset price came down, right? Because it's important to understand, like, bond prices and yields work inversely. So if the yield goes up, the price goes down. If the bond price goes up, the yield goes down. So when the Federal Reserve was raising interest rates and all the yields on all the bonds started to go up, that bond price itself started to fall. So what it is that they were sitting on their balance sheet was an asset with a dollar amount on it. It says we could sell this asset for this much. When the yields went up, the asset price fell, and now the bank is sitting on an asset that they cannot sell for what they had anticipated just a few weeks earlier when the yields were much lower. So as the asset price started to fall, their balance sheet became imbalanced, right? They had more liabilities than they had assets. Now selling the asset off meant that they would take a loss. This problem that many banks were facing at the time when those yields went up, when the Fed raised rates and all those yields went up and the bond prices fell, the Fed knew that was going to take place. There was so many people out there who were talking about the coming bank collapse and the banking crisis that was about ready to happen. That's what they were talking about. When those yields go up, those asset prices go down, and they thought for sure the banks were going to fail. Now, many people asked me at the time, dude, are you worried about keeping your money in the bank? And I said, not really. And they said, why? And I said, because the Federal Reserve has talked about having lifeboats, essentially tools, to deal with this sort of a scenario. Now, they didn't describe them in detail what those tools were. They just said that they had them. Because if they talked about what it was those tools were, or how they were going to deploy them, or when they were going to get deployed, the people, the markets, would then start pricing those things in. That's why the Federal Reserve, well, all of a sudden, boom, bank term funding program. They didn't announce that they had it ahead of time. They just all of a sudden deployed it as soon as the case was needed, right? So as the asset prices started to fall, when the yields went up, the Federal Reserve stepped up with the bank term funding program and said, hey, all those assets that are losing value because the yields are rising, we're going to lend you money at full face value of those things. Right? So don't worry about the prices falling and having to sell them. We will lend you money using those assets as collateral at full face value. There you go. There's your money. All right. So now you're made, essentially you're no longer out of balance. You can essentially make your liabilities or get your liabilities back in order to cover that. This is what the Federal Reserve had done during that crisis situation. Now, any crisis that comes, I'm assuming there's going to be some sort of deployment of a tool similar in fashion. Now, whether or not it's the same, because of the asset price falling, whether or not it's that sort of scenarios, who knows? But whatever it is, the Federal Reserve generally has the expectations of what tools that they would do or use during those particular times. Is that a good thing or a bad thing? I guess it's really depending on the position that you end up holding at the time. It really depends that way. Like, are you anticipating a complete failure so that your gold and silver and Bitcoin all of a sudden become the only currency and that's what you're hoping for? Or are you actually anticipating that the Federal Reserve is going to maintain this system, and keeping your retirement in those treasury bonds seems to be the appropriate move? Everybody has to make their decisions for themselves, right? This is the point of this channel, is to truly internalize this information for yourself so that you know how it is that you can conduct yourself, because this is not easy, right? Especially considering where it is that you need to be inside of your life. Are you 18 or are you 80? It's huge difference, right? And so many times I see out there, like I was watching this TikTok video or something earlier. I don't even know where it came from. Anyway, this guy, he had a lot of views and he was really adamant. Like, he knew what the Federal Reserve was doing. He was going into it. He sounded very confident. He had all the surroundings that showed all the professionalism. And I was just like, oh man, I want to hear what this guy has to say. And he was like so lost. He was so lost. He's talking about firing up quantitative easing and all this other stuff. And I'm like, dude, they got to go to zero interest rates before they'll even do that. Like, you're making, like, he's completely making stuff up, like just firing it off like out of nowhere, you know? And I'm like, okay, man, go for it. You keep telling your followers how it is that they're going to do that. And, you know, you're going to end up suffering the consequences of it, because really, to understand how it is that the Federal Reserve conducts monetary policy nowadays really has to be internalized that they don't necessarily adjust interest rates to do it, right? It's the spoken words about it. That's the important part. Understanding the neutral interest rate, super important. This other guy never even brought up the neutral interest rate, never once ever said it. And I'm like, how can you possibly talk about monetary policy without incorporating the neutral interest rate? That doesn't make any sense. Like, you can't do it. If you are not incorporating the neutral interest rate into it, then you are not talking monetary policy at all. You're just talking artistic fantasies, pure imagination. All right, what time is it? Alrighty, guys, I got a few more minutes here and then I got to go. You've been on it since pre-COVID. Well, thank you very much. I really appreciate it. I have been trying to share what it is that I have been finding through the Fed's speeches. So when people say, man, you've been on this since COVID, really, I'm relaying the information that I'm finding through the speeches. This is going back. I mean, you think about it. Really, I found a really good speech the other day given by Lael Brainerd. Here we go. This thing, I mean, holy moly, talk about like exposing the truth. Let me see if I can find some of this stuff here. All right. Here, let me read this little section. This came from a speech given May 16th, 2019. So this is even before monetary policy strategies for a low neutral interest rate world. So this one is the disconnect between inflation and employment in the new normal, right? So again, people are thinking when they lower interest rates, all these people going out there to work and all these people work and all of a sudden going to create this inflationary scenario. That's not the case. Lowering interest rates and getting people to go to work does not create the inflationary scenario. That's an old school mentality that is no longer working. Of course, it is not this is coming straight from the speech. It is not entirely clear how to move underlying trend inflation smoothly to our target on a sustained basis in the presence of a very flat Phillips curve. Let me read that again. See, this is them admitting they cannot get the inflationary scenario that they were looking for. This is Lael Brainerd, FOMC 2019, admitting that they were failing. Of course, it is not entirely clear how to move. It is not clear how to move underlying trend inflation smoothly to our target on a sustained basis in the presence of a very flat Phillips curve. That means unemployment, low unemployment was not creating the inflation. That means that inflation was not rising on the unemployment, or low unemployment. One possibility we might refer to as, quote, opportunistic reflation. Get that? Opportunistic reflation. This is coming straight from the Fed, FOMC 2019. Opportunistic reflation. I love this term, right? That should be the title of a video. Opportunistic reflation would be to take advantage of a modest increase in actual inflation to demonstrate to the public our commitment to our inflation goal on a symmetric basis. For example, this is awesome, right here. For example, suppose that an unexpected increase in core import price inflation drove overall inflation modestly above 2% for a couple of years. Wow, Brandon, you are a future teller. Holy crap, I mean, could you not foretell the future any better? Let me read it again. For example, suppose that an unexpected increase in core input price inflation drove overall inflation modestly above 2% for a couple of years. Huh, wow. Totally got what you wished for, didn't you? I mean, COVID did exactly that for you. Huh. 2019, asked for it. 2020, delivered. The Federal Reserve could use that opportunity to communicate words, spoken words, right? To communicate that a mild overshooting of inflation is consistent with our goals, and to align policy with that statement. Got to keep interest rates low to make sure the job is done. Inflation is running high, but we're going to keep interest rates low to make sure the job is done. You remember that? You remember Jerome saying that? Extra low. I was saying extra low, extra long to make up for the fact that they failed to achieve the 2% target over the previous 10 years. But there's another way of saying it too, right? Such an approach could help demonstrate to the public that the committee is serious about achieving its 2% inflation objective on a sustained basis. Does she not just describe inside of this short paragraph exactly what it is that had taken place with her policy? I find that pretty incredible. For example, suppose that an unexpected increase in core import price inflation drove overall inflation modestly above 2% for a couple of years. Man, got exactly what you wanted, didn't you? It's just incredible to see it. Like, to hear them talk about it and then watch it get delivered, and then people go like, oh, they don't know what to do with this. And I'm like, the hell, they didn't know what to do. They were wanting that, hoping for it, got it delivered, and they were giving each other high fives in the background. They were like, we got it, suckers. We got our opportunistic reflation. Again, guys, go look it up for yourself. This is May 16th, 2019, Lael Brainerd, the disconnect between inflation and employment in the new normal. She delivered that speech to the people. Did anybody hear it? Anybody? All right. I gotta go, guys. You are so awesome. Opportunistic reflation sounds fishy. Doesn't it not? Does it not? Why is it that nobody else brings this stuff up? Why? Like, I see so many of these super intelligent people that I know personally that don't dive into this. Like, they got all kinds of good information. I'm not saying their information is not good. They got information that is so deep in understanding that, I mean, it overwhelms me trying to understand what the hell it is that they're even talking about. Why don't they talk about this? Wanting elevated inflation and inflation expectation to save the monetary policy. Everybody who pointed their finger at the Fed and says you're causing pain and suffering with all this inflation literally gave the Federal Reserve the power that they needed. Everybody who said it. The Fed is causing inflation, painful inflation, hyperinflation. They literally gave the Federal Reserve the power that they were looking for. They wanted you to believe that stuff. And without you believing it, they never would have been able to be successful with their monetary policy. They absolutely were desperate for it. All right. Happy Halloween. Well, happy Halloween to you, Deja Vu. Thank you so much for being here today. Thank you, All Night, for being here. Money velocity mimics inflation. It absolutely does. It's because it goes with the narrative. It's more lucrative than the truth. All intelligent people know this. Yeah, absolutely, Justin. Buffalo, exactly. Too many people drinking the Kool-Aid. Yeah. Well, what I think is incredible here, and I'm going to let this go, is that I've brought this up several times, and how many times I've actually had people accuse me of working for the Fed, being a shill for the Fed, being, part of the elitist or something of this nature. And I'm thinking to myself, I work an average everyday job. At 40 years old, I was completely broke, drunk, in debt, had nothing going for me, like vehicle broken down, like I was in a bad place. And I didn't think there was any way of recovering. I didn't think there was any way of ever getting out of that. Like, it's too far gone. The economy is too far gone. Nothing is successful here. It's all crap, right? And that's exactly what I believed and thought about. And that was why I was sitting in the position I was in. It wasn't until I finally took responsibility for my own actions and said, man, everything that I am facing right now is my own fault. I put myself right where I'm at. And anybody who is going to point the finger at anybody, it's me at my own self for my own piss poor decision making. When I realized that to be the case, I changed everything about the way I was handling myself. Giving up alcohol was probably the key to it. Once I gave up the alcohol, I just thought to myself, what is the next right thing to do? Because you know what it is. You know when you're doing right and you know when you're doing wrong. You know it. Deep down inside, you know. You don't have to question it. You know. You feel it. All right? When you start doing the next right thing, even though it doesn't exactly fun, right? You know, kind of boring at times. When you're doing the next right thing, you will start finding your life changing. You won't blame people. You won't look at it as, man, this is a horrid place. There's nowhere to go. There's nothing beautiful here. That is absolutely incorrect. There is so much wonderfulness inside of this world, and there's so many opportunities for people to take advantage of it. They really just need to go out there and do it, you know? Nobody wants gold and silver when... Schiff? Alright. High metal, keep stacking cash. The more you wait, the least you can buy. Is that everything is overpriced on the dollar is underpowered in a slow pace economy? Imagine when volatility hits, boy. The problem with being too early, you never get I am sorry. Yeah. Let's change one by one. It really comes down to that. You know? I mean, it's a matter of truly believing what it is that your outcome is. What it is that you believe about yourself and what it is you believe about your future. Whatever that belief is, that's the outcome that you will receive. If you believe, like, oh no, man, I believe I'm going to be a millionaire and I'm going to think about that. And then in 2 years, if I'm not a millionaire, I'm going to prove to you you were wrong. Like, that is not the case, man. Like, I'm going to tell you, right now, I don't think about what it is to have millions of dollars. I honestly feel like I already have it. I don't, but it feels like I do. Like, it doesn't, like, I don't have a thought in my head that says, man, that day that I see that number, $2 million in my bank account or whatever, there's going to be this profound change to my life and I'm going to feel this difference and I'm going to like, I can imagine that day will come and go and I won't even realize it happened because I already feel it. Like, I literally feel like I don't even have that idea that it's not there or that it's not coming or anything like that. A lot of times I think to myself, man, this path that I am on sends me on peaks and valleys, right? And sometimes when I'm in the valley, I think to myself, man, is this really where I should be doing? Is this really the lessons that I need to learn at this time? And then at the times when I'm at the peaks and I'm thinking to myself, man, enjoy it while it lasts because everything comes to an end. This is the way I feel about it. Peaks and valleys constantly. You take the good with the bad. It's all about this journey that you're on. If you have, like, I don't know, for a lot of people, they have a dollar, like they need this dollar amount up there. And for me, it's not a dollar amount. I don't have a dollar amount that I'm going for. It's just, I just don't have it. Right? But what I do have is this vision of what it is that my family has for comfort of life, abilities to do things that, like traveling or classes or whatever. Like, these are the type of things that I see. I don't think about toys. I don't think about luxurious things. You know, it's like everybody has this different mindset. Some people think about cars, like they want cars and houses and toys and stuff like that, and they just envision all these materialistic things. And I'm thinking to myself, I don't, like, that's something I don't want, you know? Like, I would love to have the ability to acquire whatever it is that I want in my life and then not actually have to own any of it. That is what I want. because owning stuff means you have to protect it, you have to maintain it, you have to deal with it, and the fact that it's something that is just sitting there. You can't actually own it, considering when you die, it will still be there. Who will own it after that? You only temporarily have it in your possession. So it's why, I mean, owning things, who cares about owning stuff? Having the ability to acquire things, that's the ticket, because once you have the ability to acquire it, you already feel like you have it. It's already there. So it's all about the mindset. It really is. And it doesn't, like, you know, I love when people make fun of the truck. They're like, oh, dude, man, if you were smarter, if you were more, you know, if you were better at what you did, if you were so good at the economy and all this other stuff, you wouldn't be driving that old Suburban. And I'm like, I probably would, because I am. That's exactly what I'm doing. You know? And I could go out there and get a brand new Suburban if I wanted, but then I also bought some Bitcoin today. I may not be doing that if I was driving a brand new Suburban. All right? I deployed money into 401k. I have a cash position to take advantage of a buying opportunity that comes into the future. Man, I'm thinking about it the way I conducted myself a long time ago to the way it is now. Man, I'm killing it. Like, for a lot of people out there, like, dude, you ain't killing it. For me, comparatively to what I'm doing, I'm killing it. Like, I'm doing way better. Like, I can pay my bills on time. You know how awesome that is? All right, guys, I gotta go. Uneducated Economist, you guys let me know. Oh, come on. Back here. Oh, there we go.